My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make some money. My job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Let me give you the scene. Today we saw a headline that Alphabet, the parent company of Google, might pause hiring for a couple of weeks. And it immediately bruised the average, although it didn't do as much damage as a similar story about Apple on Monday. Stocks only recovered. Dow gained 48 points, S&P jumping 0.59%. NASDAQ poll voting 1.58%. I am so glad about one thing. I am glad that this reaction was much less hysterical this time. But you know what? It is still ridiculous that anyone is freaking out over these stories still. These stories about a hiring slowdown, as unfortunate as they are. Think about it. If you're a CEO, and if you watch an hour of programming on this network, you're going to hear some commentators say that the Federal Reserve is trying to cause a recession. I mean, that's what they keep saying, but they keep saying what they keep saying. They know nothing. Every night I tell you to expect a Fed-mandated slowdown because that's the only way for Jay Powell, Fed chief, to get inflation under control. Notice I said slowdown, though. All right, if you're an executive with even, say, a half a brain, how would you react to that narrative? Are you really going to double down on hiring? Are you going to say, hey, you know what? This is the time when we should really bulk up on good employees because that's prudent? No way you wouldn't do that. It's not prudent. It's just plain stupid. Anyone who runs a giant company will look at the current environment and try to do more with less. Because when the Fed tightens, your clients, the people who you really report to other than your shareholders and your stakeholders, but your clients will likely spend less than they would otherwise. No matter who. That's what they'll do. When you hear Fed-mandated slowdown, it means less hiring and more layoffs. Now, I know some people will make the kind of argument that I used to make before I sold Bar San Miguel to my manager. I always said, hey, listen, if we only get a good return on our investment on Google Maps, we should cut all the other advertising out and just throw the money at Google. There will be people who make that same choice. It's definitely the superior way to advertise, but that's not enough to offset the damage from a Fed-mandated slowdown. In the end, the advertising business is indeed hostage to the broader economy. Always has been, always will be. Even if Google's better than the rest, this is what I call a suboptimal environment for them. How about Apple? All right, well, Apple's products are expensive, all right, which means they have economic sensitivity. So should Apple just presume that more people will buy phones when they get laid off? I think they're wise to hire less aggressively. Hey, how about Meta Platforms, the artist formerly known as Facebook? I paid $300 for an Oculus Quest to get into the metaverse because I really liked what it was like when I was in there with Mark. But let's be honest, if you're working in the flagging housing market or a mall-based retailer or an automaker like Ford, which just today decided to lay off 8,000 people in its internal combustion unit, you're probably not reaching into your wallet to buy a $300 virtual reality system. You're going to wait. Oh, by the way, and Mark Zuckerberg, not an idiot. He's not going to keep hiring people aggressively if there's nothing for them to do. I bet he did so much hiring in the last 6 months that he can do well just waiting to see who's good and who isn't. Now, maybe you're thinking these are just more mature companies in this environment. And if you want mature companies, well, why not just go buy Clorox and Coca-Cola? Classic recession-proof names. But Clorox sells at 36 times earnings, making it even more expensive than Alphabet at just over 20 times earnings. Facebook at 16 times. Coca-Cola stock trades at the exact same multiple as Apple's. You aren't exactly paying up if you buy these big tech names here. That's why they're so intriguing. That's why Micron was intriguing when it was at 53 and it went up 10 points. Lower prices get intriguing to me. So let's talk about what is really going on here. For the most part, corporate America always trying to do more with less. Hey, you know, I like the stock of Bank of America. And one of the reasons I do is because I'm not heartless. I'm telling you that right ahead of it. But it's closing branches and getting a better return on its investments in the remaining people and technology it buys. If that kind of story makes us want to buy Bank of America, Why the heck should the same thing make you want to sell Google? That's absurd. Do we want Apple to make excess inventory to please Wall Street? Believe me, Wall Street won't be pleased when it sees the numbers. I'd much rather Apple recognize that we're going into a worldwide slowdown where it makes sense for them to be judicious about what they spend their money on. Look, this is a different time for America, and it's a different time for Apple and Alphabet and Meta. The last time we had a recession, they were much smaller, much less hostage to the broader economy. These days, they are indeed more cyclical, meaning they need a better economy to thrive. That's why it makes sense for them to hire fewer people. This cyclicality would be a real problem if their stocks were expensive versus the broader market, or even versus their own historic valuations. But right now, they're actually quite cheap. Now, maybe you don't want to run the risk of owning a stock that can go down hard on an obvious headline about hiring. Well, you know what? You got my blessing to park your money in something more defensive. That said, the defensive stocks simply aren't bargains here. Neither the drug stocks nor the packaged goods stocks are cheap. They've also got all sorts of risks from supply chain woes to government intervention that can cause quick declines. So what is the solution? Fair question. I'm going to offer you a menu. First, you could sell and go into two-year treasuries and make more than 3%, much less than inflation, but risk-free. Second, you can build a dividend portfolio that's very defensive, but it won't be that safe if the Fed just keeps ratcheting higher. Third, you can trade in and out, be one of those banshees. In the futile hope of dodging the occasional bad headline, probably losing money while you do it. Or four, you can take long-term positions in what you like, or simply buy a very good index fund in terms of the low cost and hold it. That's been the best form of investing. It's one that historically handily beats inflation, beats the averages. I know when this show started 17 years ago, people thought it was a day trading proposition. In Canada, we did suggest a lot more trades early on, in part because that's what viewers demanded. But these days, I think it's much more useful to focus on long-term investing, especially in this kind of market, with the choice being among different asset classes, as well as personal concerns that you may want to vote on, something we will hear about later when we talk to Larry Fink, who runs BlackRock, happens to be the world's largest asset manager. Here's what you have to ask yourself. Do you want CEOs to be clueless about what we all know is happening? When mortgage applications are down huge, when cancellations for home purchases are spiking, do we want home builders to go full blast? Do we want retailers with tons of superfluous inventory doubling down on clerks? Do we want software as a service companies to pay up and steal talent from other tech outfits, paying top dollar for each one that they pilfer? Personally, I want to bet on executives who can acknowledge reality. And right now, the reality is the companies with economic sensitivity need to be judicious in their hiring, because the Fed's lowering the boom on us, so stop freaking out. I think the Fed can steer us in for a soft landing, but so what? I don't run a giant advertising company like Alphabet or a company like Apple that sells millions of dollars and billions of dollars in different goods and services. The bottom line, if you want to invest with profitable companies, be my guest. I want to invest in well-run companies like a Google, like an Apple, like a Meta, with very smart CEOs. That means buying the stocks of those companies that think twice about continuing to hire in this environment, because they don't want to bet the house on Jay Powell. As much as I like the guy. David in Florida. David.
Booyah, Cramer, and congrats on the new studio.
Thank you, man. It's a pretty good-looking thing. Oh, don't ever put your back to it, is what they say, okay? What's going on?
I'm looking at Crown Castle. I'm wondering if it's a good time to buy into the stock.
White Castle?
Crown Castle, sorry.
Sandcastle.
Crown
Oh,
Castle.
Crown Castle. I was going to say, I had a White Castle the other day. It's not as bad as you think. But Crown Castle, no. And the reason why we can't be in Crown Castle is when rates go higher, people sell Crown Castle. And not only that, there has been churn in Crown Castle. So I like Sandcastle more and I like White Castle more than I like Crown Castle. That's 2 out of 3 castles. Let's go to Carter, Illinois. Carter.
Booyah, Mr. Cramer. How are you?
Booyah. I am good. Thank you. How about you?
I'm doing all right. Thank you. Jim,
Excellent.
I'd like to congratulate you on your new studio, and I just wanted to say thank you for fueling my interest in business and finance as I'm beginning college.
Yes, that's what I want younger people in to do sensible things. Now, I know some of my colleagues, I have this guy, Ben Stoto. He is my research director, and we go back and forth about the idea. Sometimes he says we should put everything into GameStop or maybe everything into AMC, and then I throw a bottle at him. Okay, what's up?
All right. I totally agree with you. I like sticking to the safe route. But after reporting strong earnings and increasing its dividend, I'm wondering what your long-term opinion is on FedEx.
Okay, I am so glad you asked me. And by the way, I was joking about Ben Stoddard. He really likes Dogecoin. FedEx, I think, has got a unique opportunity with the new CEO. I thought Fred Smith did a terrific job. I am such a believer in FedEx that I have to think that you need to buy it right now, tomorrow morning. That's how much I like it. You know what? Let's speak to Rick in Illinois. Rick!
Hey, Jim, second time, long time.
Second time, long time.
Member.
And club member. Yes.
Yeah. Hey, not too long ago, you did a segment on metaverse stocks.
Yes.
Of course, it was Meta, Microsoft, and Unity Software. I have a position in Unity, and they just bought another company called FireSource.
Okay, but here's the problem. The ones you've mentioned, the one you mentioned last is the one that doesn't make any money. And we are deeply focused on companies that make money, especially companies like Meta, like a company like a Microsoft. But Unity is too speculative for me, okay? I don't want to do that kind of speculation. And once again, I apologize. I'm making fun of my research director. He's the best there is. There. I feel better, even though he favors the Washington, the Commandos. Something like that. All right, look, I want to invest in well-run companies that have very smart CEOs and think twice about continuing to hire crazily and stupidly in this environment. On Mad Money tonight, BlackRock has its finger on the pulse of global markets. So we're going straight to the company's CEO in a two-part exclusive to discuss everything from the company's growth drivers to macro trends. Hey, then from Mexico to Europe, there are a handful of headwinds facing Sempra, one of the best performing utilities in this world. So how is the company planning for the future? I'm going to get to the latest from the company's top brass. And is it time to retire the obsession with Netflix? I'll give you my take. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.